In Q2, the equity market transitioned from don't fight the Fed to don't fight the tape, as large US tech firms continued to rally and left the rest of the market in their dust. This bifurcation of the US equity market between the so-called Magnificent Seven, AI-exposed US tech firms and the rest reflects a somewhat confused market. I'm Paul Delaney, a wealth advisor with Capital Endurance Group. I'm going to discuss some of our observations about key indicators in the capital markets as we move into the third quarter of 23. There is some data to suggest that for the time being, leading indicators of business conditions have troughed and might be ever so slightly improving. That's moved us from quadrant 4, the contraction phase, to quadrant 3, the expansion peak phase of our risk positioning matrix. To be fair, data is so mixed right now that we could assemble a very credible bear and bull case for stocks. This is one reason why the rally in large cap tech stocks has been called the most hated rally in recent memory. Many seasoned investors remain skeptical the market can defy troubling economic indicators. For now though, we're in quadrant 3 where we want to assume full risk exposure to equities while being on the lookout for a recession. Let's start by looking at the performance of the S&P 500 to June 30, split between the so-called Magnificent 7 plus Netflix and the other 492 stocks in the index. The Magnificent 7 plus Netflix provided about 4/5 of the S&P 500's return, or 10.82%, shown here on the chart, with the remaining 492 stocks coughing up a paltry 2.88%. Why has this happened? The unveiling of ChatGPT combined with Nvidia's first quarter earnings beat and bullish earnings outlook set off a rally in large US tech stocks perceived to be able to profit from AI. And the sheer size of the Magnificent 7 in terms of market value has dragged the overall index up, despite the other 492 stocks trading sideways. So in many ways, bears have not been as wrong as the overall index return might suggest. The market seems to be telling us that while the other 492 stocks in the index are subject to a worrisome economic backdrop, the Magnificent 7 have a combination of superior growth prospects, expense savings opportunities, and low reliance on debt funding in a rising interest rate environment that make them worth more. You can see here that the top 10 stocks in the S&P 500 at June 30 had increased their share of that index's market cap to 31.7%, despite their share of earnings actually declining. The price action for the top 10 is all optimism about the future. So what are some of the major macro indicators telling us? The theme this quarter is that for every negative indicator, a positive one as a counterpoint is readily available. The Treasury yield curve remains deeply inverted and has been for about 9 months now based on the 10-year to 3-month rates. Inversion like this usually precedes a recession, but with a variable lag. And yet the OECD's composite leading indicator for the US, which incorporates bond market data with other data such as housing starts, consumer confidence, and weekly manufactured hours worked, amongst others, suggests business conditions have stopped getting worse. The federal funds rate has rocketed up to 5.25% and looks likely to go to at least 5.5%, which means the prime rate for business lending is now an astonishing 8.25%, which has crushed demand from businesses for bank loans. And yet monetary policy might still not be that tight if we measure monetary policy on the basis of the real federal funds rate, which EPB research estimates to be all of 0.5%, barely above zero, and well below the pre-credit crisis peak of 3.2%. It also appears that the Fed's response to the regional banking crisis in March flooded the system with more liquidity, effectively reversing its much-touted balance sheet reduction back to where it was at roughly year-end 2022. We can see that in this chart from Fidelity. The pink BTFP line shows roughly $294 billion was pumped into the financial markets to stabilize banks struggling under the weight of Fed rate hikes. The Fed pumping money into the financial sector tends to lower bond yields and support stock prices. We can see the stock price impact using the Chicago Fed's National Financial Conditions Index, which is in blue here. The blue line going higher means financial conditions are tightening, bad for stocks, while the blue line going lower means financial conditions are loosening, which is generally good for stocks. The Fed pumping more money into the markets in response to the regional banking crisis loosened financial conditions, as we can see by the blue line at the right heading downwards. Unfortunately, investors have to predict where the Fed will meddle next, in addition to figuring out what the actual fundamentals like earnings are for companies. For company earnings, an excellent data series that gives us a hint at what lies ahead is the ISM Purchasing Managers Index for both manufacturing and services. When the index goes below 50, it indicates contraction in activity. At the 46 level, manufacturing is well into contraction. And yet, services has broken its downtrend towards contraction and bottomed out at 53.9, still in a modest expansionary phase. In the bottom panel here, you can see that the ratio of manufacturing new orders to inventories shows positive momentum, which could signal that the manufacturing sector is nearing its bottom too. Corporate bankruptcies are surging this year and are at their highest level since 2010, when we were coming out of the credit crisis. And yet, high-yield credit spreads show no indication of credit stress. Initial claims for unemployment have reached the level at which historically we would see a recession, and yet the more reliable indicator of recession, continuing claims, has just recently stalled out below the historical recession trigger level. Why? Well, part of the reason is that very cyclical employment, which includes things like residential construction, manufacturing, trucking, and temporary help services, has flattened out at a positive 0.1%. This is great news for workers, but not a fast enough deterioration to tell us recession has arrived. The key variable that this market seems to be responding to is declining inflation. Last week we saw CPI show continued improvement. We see from this 3-month annualized data that total CPI is now down to 2.7%, with rent, which is running at 5.6% on this measure, stopping the CPI number from declining even further. We also saw producer price inflation show rapid deceleration in June to just above zero, which generally feeds through into consumer prices shortly thereafter. So the progress on inflation is slow but steady, which is good news. It's critical the Fed continues to make progress on inflation to keep the market's long-term expectation anchored at its 2% target. Here we can see that as the Fed has hiked rates over the last year or so, inflation expectations in the bond market, measured here by the 5-year TIPS break-even rate, is at 2.16%. History shows when inflation above 3% gets embedded into expectations, PE ratios decline significantly. For example, in 1980, as inflation was peaking after the inflationary 1970s, the S&P 500 traded at a mere 8 times earnings, half of what it sold for a decade earlier. The Fed is aware of this. The S&P 500 index is a market value weighted index. If we compare that with the same index constituents weighted equally, we can see how the large cap companies have been performing relative to the smaller cap constituents of the index. This is the year to June 30 chart. The equal weighted index is 10 points behind the regular market cap weighted index. Now let's show the same chart for just the last month. You'll see both versions of the index are tracking roughly together. This shows how in the last month or so the rally in the S&P 500 has broadened out from just the largest market cap tech names to more of the index. That is reassuring for those skeptical of this market rally. Thanks for watching. We'll see you next time.